Hello everyone, thank you for attending. My name is Charlie Nicolay, and I'll be presenting on macroeconomic policy news and U.S. stock market indices through an investigation of the efficient markets hypothesis. So a little bit of outline for this presentation. I'll go over the basis for my research and my research question. Then I'll go over some of the literature on this topic, and then go through my theoretical and empirical foundations for my study, and discuss some of the data sources and the interesting summary statistics within that data. And finally, I'll conclude with my empirical results and analysis. So the research the question I'll be researching is there a relationship between macroeconomic policy news releases and stock market returns? And this question is really grounded in the efficient markets hypothesis, which states all relevant public information is fully and accurately priced into the value or prices of stocks. And this study is relevant because it can provide insights for policymakers, shareholders, and portfolio managers. Policymakers can observe how stock market shocks can spill over into real economic activity. And then shareholders and portfolio managers can increase their investment portfolio returns by understanding how the efficient market hypothesis implies that portfolio diversification benefits from a low correlation between the stock market and public information. So some of the background literature that I've used for my research, Fama, who is considered kind of the grandfather of the efficient markets hypothesis, used 3 of his articles. 2 of them similar to Josh's earlier. In 1965, Fama talks about the theory of random walks in stock prices, which kind of states that that new information can change the stock value, but previous stock prices have no real validity for forecasting stock prices. This really started what's known as the weak form of the efficient markets hypothesis, which really is talking about stock prices not being able to be used to forecast those future stock prices. And then another interesting note in this paper was that Fama mentions there's no general theoretical model for predicting stock prices. So that kind of goes forward into which theoretical models are we going to use to kind of predict stock prices. And then moving on, in 1969, Fama studies the release of stock split announcements on predicting stock prices. And what he finds is that you can't use the release of announcement that like a stock is going to split to capitalize on those returns because it's not predicted. But an interesting thing that I did find was that the markets can use these announcements of new information to reevaluate the stream of expected income. And this kind of goes into the generalized dividend valuation model, which I'll get into here in a second. And then lastly, in 1981, and also the bottom article, Chen, in 2009, both kind of investigate the stock market inflation relationship. And I use these as a theory because inflation is one of my most important variables in my study. These 2 articles explain kind of a relationship between inflation and stock markets. And from this 1981 article, Fama suggests that stock returns and inflation are strongly related measures of future real economic activity. And Chen in 2009 kind of adds on to that and says that inflation and interest rates are kind of the most useful predictors for, he calls them bear markets, which is another term for recessions, basically. And then in 2001, also Guthrie, I kind of used this article for my empirical method. He uses 8 different econometric models to test macroeconomic variables' ability to predict the level and volatility of Saudi stock market returns. And this paper was kind of interesting because it's studying 2 different things, the level of stock market returns and the volatility. So he was kind of going at both angles of kind of the research in this area. And what he finds is that you can't really predict the level of stock market returns from macroeconomic variables, but you can hint towards the volatility. And one of the conclusions in this paper was that that policymakers should consider the volatility of a stock market when implementing new policies. So for my theoretical framework, I start with the generalized dividend valuation model, which basically states that the intrinsic value of a stock, so not the price, but the real value of a stock, is the present value of the sum of all future cash flows. And this really gets back to the Fama 1969 article, which states that those market news announcements can be used to reevaluate the expected stream of income. And that goes into the cash flow on the top, the numerator, that these announcements can be used to reevaluate all those future cash flows, which would have an impact on the intrinsic value of a stock. And next, this kind of flows into the Gordon growth model, which gets at the efficient markets hypothesis. So the Gordon growth model is another way to calculate the value of a stock. It uses the growth rate of dividends to calculate the value of a stock. And what the efficient markets hypothesis is really getting at is this growth rate of G. So you can see that G is found in 3 of those dividends. And what the efficient markets hypothesis gets at is the market efficient, and is it efficient in getting the accuracy of changing G? And so what really changes the value of a stock is that G, the growth rate of the dividend, is truly the only thing that will change the value of stock. So is the market efficient in allocating that new information into changing G, which therefore changes kind of the whole value of a stock? And then kind of a gap in my theory comes from Chen in 2009. While these models talk about the value of a stock, Chen states that macroeconomic variables do a better job of predicting bear markets than predicting stock market returns. And so for my empirical framework, I used a OLS regression model. And so my dependent variable is the index return, and I used the 3 main US stock market indices, so the S&P 500, the Dow Jones, and the NASDAQ. So I have 3 separate regression equations. They're all the same except for changing my dependent variable. And then the lagged aspect, so the inflation rate, the interest rate, the unemployment, and the jobs reports and GDP growth are all lagged because that information is reflected in the next day's stock prices. And so for my empirical predictions, I predict that interest rates will have a positive coefficient. Because interest rates reflect borrowing in the economy, if interest rates are going up, that means that the economy is healthy and that more people are increasing borrowing. When the interest rates are going down, that's usually to entice borrowing more, to kind of boost the economy out of a recession. And for inflation reports, I did not use the consumer price index, which is kind of the real inflation rate. I used the 10-year break-even inflation rate, which implies what market participants expect the inflation to be within the next 10 years. So I use this inflation rate because it kind of looks towards the outlook on what market participants expect inflation to be, rather than what the past it has been. And then unemployment news, I expect to have a negative coefficient, just because when the unemployment increases, that's kind of a sign of the economy that it's going down. And that'll impact stock returns. And then jobs reports and GDP growth are kind of opposite of unemployment. They're both aspects of the health of the economy, and that if they're doing well, then the economy is doing well, therefore stock returns should be higher. For my data, my dependent variables, the stock market indices, is daily open and close prices from Yahoo Finance. And then my independent variables for my macroeconomic variables are all from Fred, with the primary source listed there. And then my dummy variables, I use the announcement dates of new information. And so interest rates is the Federal Open Market Committee's 8 meetings a year, and they kind of set the effective Fed funds rate. And so those meetings, they would announce new information that changes the interest rate. And then inflation is the consumer price index release date. So I think it's first Friday of every month. And while I use the 10-year break-even inflation rate, that changes from the consumer price index. And then unemployment and jobs reports are from the monthly employment release dates, which is the middle of every month, like the 15th or 16th. And then GDP growth is the quarterly GDP release from the Bureau of Economic Analysis. And then in figure 1, I kind of show one of the more important relationships that I'm studying in my research, which is the positive correlation between interest rates and inflation. From that scatter plot, you can see as inflation rates increase, so do interest rates. And the only caveat to this is kind of when inflation is high and interest rates are 0, you can see kind of the two hot spots there. That's really during the 2 recessions when inflation is high and the government sets the interest rate low to kind of boost us out of a recession. And then in figure 2, this is where I get into the efficient markets hypothesis. So this is the average daily S&P 500 return with 2 different categories. So new information is released and there's no new information released. So when my research question is asking, does the release of new information affect stock market returns? Figure 2 here really gets at that evidence for that argument, because the daily return is much higher for when new information is released versus when no new information is released. And so after I ran my regression, got my regression results, which were kind of interesting. They were not really as expected. My predictions were a little bit off. I predicted unemployment to have a negative coefficient, and across all 3 indices, they have a positive coefficient. And then the positive correlation between interest rates and inflation actually correlates to a negative relationship in these coefficients because inflation is negative. And so of my 5 variables, inflation has the highest impact on stock market returns. And the jobs reports have the least amount of impact on stock returns. This can be because jobs reports mainly are like an indicator of the health of the economy more than like the actual stock returns. And another interesting finding was my dummy variable for the interest rates release. So those are the 8 Federal Open Market Committee meetings a year. And what those coefficients are saying is as you move from 0 to 1 for my dummy variables, so from no new information to new information being released, that correlates to a higher change in stock market returns. And then my variables that were statistically significant were inflation and interest rates released dummy variable across all 3 indices, and then 2 of the variables for GDP growth in the S&P 500 and the Dow Jones Industrial Average. What's interesting to note here is that because I have 3 regressions, like I said earlier, it's the same regression except for changing the dependent variable. The size of the indice matters, and so obviously the Dow Jones is one of the biggest indices, and that's correlated to the coefficients being much higher, with the S&P being the smaller index. That correlates to less of an impact from these macroeconomic variables. And on the bottom, my R squared for my empirical results is very low, which isn't necessarily bad. It's just meaning that there's little variance in stock market returns can be explained by the 5 macroeconomic variables used. But if you look at the F-test, with very high confidence, we can reject my null hypothesis. And my null is that there's no relationship between stock market returns and these macroeconomic variables. So kind of conflicting evidence there, but showing that there's little variance from these from stock market returns can be explained by these variables. But there's no you can reject the null. So there's there's not no relationship in there. And so for my counterfactual analysis, this is where I get into the size of the index matters. And so figure 3 is showing the average daily open and close price from 2003 until present. And so what it shows is obviously the S&P is the smallest, with the Dow Jones being the largest. and showing up, the Dow Jones is much bigger than the other two. And this kind of leads into figure 4. And so figure 4 is changing the inflation rate. And so the one there is the normal or the mean inflation rate. Excuse me. And as you decrease the inflation rate here, so you move to 0.8 and to 0.6, that correlates to increasing stock market returns. And so the size of the index impacts the slope, so it impacts the stock market returns. And so as you decrease inflation, you're increasing stock market returns. And then opposite of that, as you increase inflation to 1.2 and to 1.4, that means you're decreasing returns. And this shows that the size of the index matters because the Dow Jones has the steepest slope, so it has the most variability from the change in inflation rate, and the S&P 500 has the smallest slope, so it doesn't impact from the change as much. And so some of the conclusions I have, excuse me, my very low R squared shows that very little of the variance in stock market returns can be explained by my 5 macroeconomic variables. But of those macroeconomic variables, inflation seems to have the most effect on stock market returns. And then, like I just stated, the magnitude of those coefficients and of those stock market returns is really dependent on the size of the index. Some of the limitations of my study, I would say, is limiting to 5 macroeconomic variables. Because I was doing daily stock returns from 2003 to present, the data would be much bigger if I increase that from those 5 variables to 10 variables. Because there's numerous macroeconomic variables, the more you add, the more variance, the higher the R squared would be, the more variance would be absorbed in the stock market returns. And then a caveat to my study would be, I didn't distinguish my dummy variables between good and bad news. So each macroeconomic variable had a dummy variable for the release of new information, but that new information wasn't distinguished between good or bad, which can have an effect on stock market returns. And so kind of adding to the study, I would have 2 dummy variables for each macroeconomic variable, one being good and one being bad. Thank you for listening.
So, questions from?
Yeah, I have a question. Can you go back to your counterfactual, please?
Yep.
Perfect. Okay. And so, just to clarify, what is the y-axis on figure 4?
So the y-axis is the stock market returns, or the average stock market return.
Okay, so it'd be like, for like the Dow Jones, it'd be like going from 14,145 to like 14,160 or something?
Yep, and so it's not like percentages, it's just
Gotcha.
return.
Okay, so then my question would be, so I see that because Dow Jones is by far the the biggest indicator, that's why we have the most negative slope here. But I'm wondering which of these relatively has the most impact then, right? Because of course the Dow Jones has the largest slope because that's the biggest indicator.
Mm-hmm.
But which of these relative to the size of the indicator is having the most effect, if that makes sense?
From the inflation rate?
Yeah.
Yeah, I mean, again, I would say it's Dow Jones, even though one of the reasons why it is the biggest index.
Uh-huh.
Not only that, is that the Dow Jones is made up of primarily blue chip companies, and so those are the more established companies which are more impacted by inflation.
Mm-hmm.
So while a lot of the variance in that slope is from the size of the index, it could also be from those companies be kind of more exposed to the inflation rate. Yeah.
So if you had GDP, unemployment, and jobs available, did you kind of run into any multi-collinearity when you were running your regressions?
Yep, and so if you go through the results, you can notice the dummy variable for jobs release is all omitted because of multi-collinearity. And that's really because the unemployment and the jobs information is all coming from the same news release. The employment status release each month has unemployment and jobs data and news on there. And so, yeah, that's multi-collinearity right there.
When you're talking about new information, how often is there
no new information released on a particular day, because I feel like when looking at the market as a whole, there'd be new information every single day.
Yeah, and so that's what I had to distinguish between is just the new information of these 5 variables, so the exact release dates of new information for my 5 variables. And so the interest rates was obviously the 8 meetings a year from the Federal Open Market Committee, which they set the effective Fed funds rate. The inflation is the release of the monthly CPI, so they update the CPI every month. So that's like the first Friday of every month. And then the unemployment and jobs data comes from the monthly employment releases. And so when you pull it all together, of my like 5,000 observations, I think only like 500 of those days had new information released. So from my study, there's a lot more days that there's no information versus the new information being released.
So, very good. Charlie, I will sort of ask you sort of the questions. What did you get out of this? I mean, not necessarily academically, what's the value of this project overall as part of the academic program that we have?
Yeah,
right?
I mean, the value of it would be kind of studying how these macroeconomic variables affect stock market returns. So as an econ major, we all take macroeconomics, and we kind of learn that, but we really don't study what those macroeconomic variables effects have on like the real economy, or how they can be applied to the real world. And so I chose this mainly just because I'm interested in the stock market. But it's also interesting to see how like those macroeconomic variables we learned about in macro can kind of spill over and have real world application into the stock market. Even though there's low variance that can explain by these variables, there is still some effect that these variables have on stock market returns.
So, bigger question, and anybody who just presented can answer this. What did you develop? What development can you point to as part of the process? I mean, it's not the economics, but the intellectual development.
Yeah, I would say determination. Working with this data was like pretty tough, especially so one of the problems I was running into a lot was the time series lag in data. So I had to lag my independent variables by 1 day, and it took a while for me to figure out this problem. But when you download stock market data, it doesn't include weekends and major holidays because the stock market doesn't trade on those days. And so it took me forever to figure out why the time series lag in data wasn't working. And it was because I had omitted days because the stock market wouldn't trade on those days. And so kind of problem solving that, I just took that as like the stock market didn't change on the weekend, and therefore no information was released. And so I kind of fixed that problem. But it also maybe could have an effect on like some of these coefficients, and R squared being like a 4-day weekend or whatever is all going to be the same information.
So for the other two, what's the development going on here? Like,
Development?
yeah.
I don't know, I'd say that it's a 4-month period. You know, you're gonna get knocked down, you're gonna be facing a mountain, you gotta climb it. But I think that you get the whole entire scope of what it means to do research. You look at previous literature, you get knee deep in it, you know, 40 pages, 80 pages, however long your papers are, and you really start to understand something that no one else really gets to understand, which is very interesting. Because when you're presenting it, you're pretty much teaching people something that you've been working on for such a long time. It's kind of like, after I finished, it was kind of gratifying for me to know that.
Yeah, I guess it's like you just become really innovative, like with Excel and stuff, so you can figure out a lot of loopholes or ways to go around things. And then like, normally like if you learn something in class, you just kind of scrape the surface, but like doing it on your own, you like learn a lot more.
Ryan, did you have something you wanted to add?
Yeah, I would say the biggest thing that I got out of it is like that differs from a regular class. Is in any regular class you can kind of lean on your classmates a little bit to like work with them on your project or homework or whatever, but with this it's so independent that you kind of have to take everything on yourself.
Yeah, yeah. Well, congratulations. Good job, everybody. We have a slightly longer break than some of the